If you look at the two key issues that, or two key areas of improvement that GCR came with, the first is that they said you need to raise equity. In this type of a market environment, it's important to have a buffer of equity, which is there for the entire business. We've seen a lot of businesses this year that have been undercapitalized and have suffered as a result. It's been there in the retail businesses, supermarket businesses, in the cement businesses. So it's important to always be able to raise equity. So that was the first thing which they said. The second was that for a company of our size, we need to have access to bank lines. And there's two sides to the story. The first is definitely we are in discussions with a number of banking partners to be able to raise bank capital. The second is that our business model has always been giving the return to the investor. So rather than going through any sort of a financial intermediary, we go directly to the investor and pay them the return we would have paid the financial intermediary. So that's always been the core of our business model. In terms of the debt to equity ratio, when you look at what is actually there in the market, it's Cytonn's about 200, and if you look at total group liabilities to equity, is actually about 237%, which is not very different from any other institution that raises funding towards deployment, where the market average is about 530%. So GCR actually told us that we need to come out and raise more debt and raise more equity. So the main reason for the B rating was for us to go back and relook at our capital structure. In terms of delivery of real estate projects, what we have been doing is accelerating delivery of some blocks that we can put out into the market. So if you look at Amara Ridge, it's now complete and delivered. For the Alma, the entire development to be completed in September of next year. However, if you look at the first three blocks to be delivered, which is blocks A, B, and G, they'll actually be delivered in February of next year. So it's just being able to fast track delivery of projects into the market. GCR then also pointed out a number of areas which have improved across the firm. The first is that they said Tallery's commitment towards Cytonn, where they invested a further $22 million this year towards real estate projects, was very, very encouraging. Also, that we are looking at really diversifying our sources of capital. They pointed out good risk management, and the management team has improved, and the strong governance structures, and the positive progress that projects are actually making when you go onto ground and you see the progress that projects such as Amara, Alma, and the Ridge have been made. They actually put that as a positive. So definitely when we sit across the table with GCR, there are areas we can improve and there are areas we can do better, just like any other player in the market. So we'll definitely be focused on looking at our capital structure this year. We already had an option with Tallery of Finland, where they are looking to acquire 20% of the company during an IPO period. So we've been very positively book building. We are in quite advanced discussions with an advisor to look to do an IPO on a recognized global exchange. So that is also proceeding well. So it's just a matter of time before the areas raised were addressed. We're looking at July 2019 for the IPO. No, we're still in discussions with advisors just to find out what is going to be the best market for us to go. But Cytonn, for a global institution, has a very compelling story. If you look at companies that generally have been listed in Africa, they have always been on the natural resources side, and now a little bit more towards the technology side. So Cytonn from East Africa, which is the most attractive area in Africa for you to invest because it's got the most diversified economies, and then having a business model which offers investors access to high yielding returns and at the same time real estate development is a compelling business model for any global investor looking to get access into real estate and alternatives in the region. In terms of decision on the amount, we are still going through decisions with brokers, so conversations are are ongoing over the next couple of months. Once we do firm down on that, we will update on the progress. There definitely, for starters, needs to be more of alignment between fiscal and monetary policy in the economy, because the two cannot run independent. They can end up having equal and opposite effects on economic growth. So as central bank decides to maintain the central bank rate at 9%, then what is happening on the borrowing side definitely needs to be looked at. But we've seen government has been very, very strict in terms of the rates at which they accept money, largely because they also don't want to cause an inflationary environment, but at the same time, money towards government securities has been so readily available. In terms of government debt, definitely there has been huge appetite for government-led projects, especially in the infrastructure space. Is there a need for government to look at possibly phasing a number of these developments so that we start to see the actual revenue impact on the economy, which can then turn around and these projects can then pay for themselves? There's definitely a need to relook at that. We also don't want to get to a point where public debt becomes such a big burden and recurrent expenditure, especially towards debt repayment, becomes such a big burden that we have very little absorption on the development expenditure side. So there's definitely a need for a review of all our government spending projects to see what we can phase, how we can borrow, and at the same time looking at how do you involve private sector in these projects. If you look at PPPs, there hasn't been a successful PPP in the Kenyan economy. But can government then create a conducive environment for private sector to carry out a lot of these projects? It will take a lot of the burden off government. Another thing that government really needs to look at is privatization of government-owned businesses. There is no reason for the government to be in cement. There is no reason for the government to be in banking or in telecommunications. Government should provide a conducive environment within which private sector operates. That brings in discipline as well, and it will create efficiencies which will reduce the need for a lot of this recurrent borrowing. Definitely, because the first is that not only turnaround in the market from the IPO's efficiency perspective, but it provides deepening of the capital markets.
Yes.
We need to see more companies come out into the market looking to raise capital locally, and then we need to see capital markets players support those companies. At the same time, if you're now subjecting a parastatal to AGMs with public shareholders, dividends, share price movement, high levels of corporate governance, high levels of scrutiny, it will naturally bring efficiency into any organization, which is what an IPO would do. When you would then go and actually raise money from the market, you would then look at what are the most efficient uses of that capital in the environment. If it's Kenya Ports, Kenya Pipeline, how is it that the capital raised is then deployed in the most efficient use for the benefit of shareholders? When that is done, given that they provide public goods, it trickles down to a microeconomic level. So number one, we need to see more deepening of our capital market. So how do we provide a framework which encourages these businesses to actually list on the local market? Second is, a lot of these businesses are actually legacy businesses with a strong Kenyan affiliation. You will start to see more local investor participation towards these companies. It will also then reduce our impact on the foreign investors who are here in the market. So there's a number of benefits towards these public companies, if not even privatizing, coming out and raising capital and subjecting themselves to the discipline of the market.
Mm-hmm.
The first is to anchor it with a number of institutional investors. Who is going to support this? Is it going to be the World Bank? Is it going to be IMF? Who is coming in as an anchor investor into this fund? Secondly is, what rates is government going to be able to provide this capital at to the fund? And the third is, are you going to be able to bring in private sector investors and still deliver to them a return which is more attractive than what they're going to be able to get in the public markets? So any sort of housing fund, or even the mortgage refinance company, which is ultimately going to be issuing bonds out so that it can help finance, needs to have some sort of a participatory right structured into it, so that investors see the ultimate upside of their investment, and it attracts more investors into the fund. The long-term economic prospects of Kenya remain very, very solid and very sound. If you look at, just take Africa as a whole. If you look at South Africa struggling with low GDP growth. If you look at West Africa, still very commodity dependent. If you look at East Africa, though, diversified economy. How do you access these diversified economies? Kenya still remains the regional hub. So the long-term economic prospects of Kenya remain very solid. All we need is, the first is allowing private sector to be able to execute in a conducive business environment, which among other things includes removal of the interest rate caps. More conversations to be had between the fiscal and monetary side. How do, as central bank and treasury, should not be operating in different worlds. So there's definitely need for more cohesion. And at the same time, also on the political front, for Kenya to be able to grow for the next 10, 15 years of sustained economic growth, which is how you saw the countries known as Asian tigers actually grow. It was 10% economic growth over a 10-year period, led to doubling of economies in 7 years. Kenya now needs that. So we can't have this stop-start every 3-4 years as we get back into politics. Then the economy shuts down for a year. And then now we are starting again.
Policy,
and starting again. So we definitely need to find a way to sustain 5 to 6% economic growth over a 10-year period for us to be able to see and achieve our goals as a middle-income economy. If you look at investors, there's a number of areas they can invest. They can invest in deposits, the equities market. They can invest in collective investment schemes. They can invest through their pension funds, or they can invest in private investments. So when you look at private investments, there's definitely a growth of the market because, number one, the returns are better. The transparency is definitely more as well. Investors get access to areas of the economy that were previously untapped as well. So if you look at generally the private investment space, it has been growing at a phenomenal rate, and we expect it to continue growing because it has to. As the economy grows, there's growth in investment generally across the entire economy.